Many tech employees unknowingly overpay by 99% on their RSU taxes. But as a CFP who's helped hundreds of wealthy tech employees avoid costly mistakes, I can show you exactly how to fix that. There's a fully legal, IRS-approved strategy to cut your taxes by up to 50%. So in this video, I'm going to show you the tax traps that can cost RSU owners thousands of dollars, the IRS-approved method to decrease your RSU tax bill by 50%, and how to automate it so you don't make that mistake ever again. To start, let me show you how this hidden tax is slowly ruining tech employees. Last year, a family member reached out to me and asked why their tax liability was thousands more than they were expecting. So I looked at their tax return and found the problem. It was hidden in their paycheck. With one simple tweak, I had their tax penalty lowered by 8%. They haven't had to worry about it since. This is a problem that plagues many tech employees with a variety of income sources like restricted stock units, bonuses, and stock options. Let me show you the step-by-step process to see if you're paying this so you can automate it and reduce your tax liability. To see how this is impacting you, get your most recent tax return. Within the first few pages, you should see a page titled Form 1040. This is the main tax form everyone files. Look for a line titled Estimated Tax Penalty. If this number is greater than 0, then you've been hit with a penalty. Next, you'll want to find the culprit. This main culprit is likely on the line that says Federal Income Tax Withheld From, as you've probably been under withholding on your RSUs. Here's the legal loophole to automate this for future vesting RSUs. First, you want to get a copy of something called Form W-4, which is simply telling the government and your employer how much to withhold from your paycheck. You can download Form W-4 from the irs.gov or get a copy from your employer. Complete steps 1 and 2 as usual. If you've previously claimed dependents, lowering or removing that amount will increase your withholding. In step 4C, add an extra dollar amount to withhold per paycheck. Give this updated W-4 to your payroll person at work. Then on your next paycheck, ensure that the new withholding is reflected correctly. But there's actually one more way, often overlooked, that lets you retroactively reduce or remove these costly penalties. There's a relatively unknown form called Form 843. That's an IRS-approved way to ask for the erasing of those penalties. This is known as penalty abatement. As a CFP tax planner for the wealthy, I made this easy by making a ready-to-use penalty abatement template. Just copy, paste, and send it to the IRS. And you could save yourself thousands of penalties in just a few clicks. Link in the description. There's one more legal loophole to look at before I expose more hidden tax traps. If it's late in the tax year and you're behind on your payments, or you'd rather not front load withholdings to the IRS, there's one more hack I help my clients use. With your tax professional, you might consider increasing your withholdings at the very end of the tax year. This allows you the liquidity up until the tax comes due. But this still isn't the biggest way to cut your taxes on your RSUs. Next, I'm going to show you the exact thing that can help you shield up to 37% of your income from taxes fast. Let me give you an example that simplifies this. Remember when you were a kid waking up feeling sick, but you were secretly kind of happy because you got to miss school? And just as you started to feel better and want to play with your friends, your mom said, "No school, no friends." I thought I got the benefit up front by missing school, but I ultimately missed out on the tail benefit at the end because I couldn't play with my friends. Taxes on your RSUs can feel just like that, taking away your fun right when you think you got a tax advantage. Let me show you how to miss school and still play with your friends at the end of the day with your RSUs, so you can cut your RSU taxes and shield up to 37% of your income. Let's say that you have an RSU that vested at $50, but the stock price has dropped to $40, where you ultimately decide to sell. That $10 loss can shield another $10 worth of income from being taxed. This is known as tax loss harvesting. If you're in the 37% tax bracket, harvesting that loss just saved you 37% on taxes for another $10 worth of gain. You got the upfront benefit, but unbeknownst to you, you could lose that whole benefit on the tail end, even if you did nothing else. Like my mom taking away my ability to play with my friends for that day, the IRS can also take away the tax benefits if you do this. If you have an RSU vesting within 30 days before, the day of, or 30 days after you sell for a loss, you can trigger something called the wash sale rule, which simply means that the $10 loss would not be allowed to offset or shelter other income. Some of my clients have had such complex RSUs and equity, there were only a handful of days each tax year where they could actually do tax loss harvesting on their RSUs. It's an overwhelming thing to remember and to try to coordinate. Here's an easy way to help you automate that mistake away to help you avoid getting caught in that expensive wash sale ever again. You could build spreadsheets with all of your RSU vesting dates, set up email reminders and calendar events, or you can simply download my free pre-built resource in the link below. Next, I'm going to show you how a lot of tech employees think they can dodge high state income taxes just through one simple move. But this next hidden tax trap cost one early Facebook employee $63,000. Back in 2012, this employee relocated from California to Singapore. As such, he figured that he had left California's tax liability behind, especially because most of the RSU growth happened while he lived in Singapore. But he soon found himself in a legal battle with the state of California over that $63,000 tax bill. The court found that his Facebook RSUs were granted and started vesting while he lived in California. The Office of Tax Appeals sided with the state of California. If your RSUs are vesting while working there, a portion of your gains can be taxed even if you cash out years later in a completely different state. So if you're planning a move to a better state to escape higher taxes, it's not as simple as packing your bags and filling a U-Haul. If you're a tech worker thinking about relocating, timing is everything. The legal loophole is the sooner you move in the RSU vesting process, the better your chances of avoiding or minimizing this tax trap. Or you can automate your protection by choosing to live in a tax-free state that doesn't have a trailing tax law. Here's a list of states known for taxing RSUs earned while you live there, even if you leave. If you want to avoid the state tax trap, do your homework before you move, or talk with a tax advisor who knows the rules in your state. Which brings us to the next big problem, which could cost you 99% in useless taxes. Your RSU tax situation is a house. In this house, a fire represents a tax problem that could burn your whole house to the ground if you don't catch it. In this analogy, the fire starts when two things come together in the wrong way, like a spark meeting something flammable. In this case, think of your Form W-2 and your Form 1099-B as two elements that can cause that tax fire. Here's how they do it. Your W-2 reports the income from your vested RSUs. It's like the spark that says, hey, you've already paid tax on this income when the RSU is vested. When you sell those RSU shares, the brokerage issues a 1099-B. If the cost basis on that form is reported at $0 or incorrectly lower than what you actually paid tax on, it's like adding fuel to that spark. Now it looks like you have to pay tax again on income you already paid tax on. The fire is the potential double taxation that can burn your RSUs to a black crisp. Without a smoke detector, you might not realize this mismatch until you're paying more than you should. But how can you set up your own tax smoke detector to spot the biggest RSU tax trap and cut your tax fire by 50%, all before it becomes a costly emergency? AI isn't ready yet to extinguish your tax fire safely, not without major risks around data security, accuracy, and compliance. But a skilled professional can step in and directly handle the situation, helping you proactively manage your RSU taxes. If you're not ready to hire professional help, you could spend hours manually building out spreadsheets, juggling calendar alerts, and trying to keep up with tax notifications yourself. Or you can skip the hassle entirely, and as a CFP who is an equity specialist, I've created a free template, link in the description, that simplifies this entire process. Think of it as your own personal smoke detector for RSU taxes. Just like your smoke detector, this won't put the fires out for you. So here's how to check to see if it's actually a fire so you can cut your RSU tax bill by 50%. Find and pull up your Form 1099-B. For those of you that have downloaded my free resource, it should already be starred, tagged, and organized for quick access in the labels. Locate the statement from your brokerage or payroll provider showing your RSU's vesting details, often labeled something like equity compensation, RSU vest, or stock plan statement. Step 2. Look at the pay stub from the month your RSUs vested, or check box 1, wages, tips, other compensation, of your Form W-2 at year end. Confirm that your vested RSUs were included in your taxable income at the time they vested. Typically, your company includes this value automatically. Download your Form 1099-B or find the statement labeled stock sale or RSU sale. On your Form 1099-B, look for the cost basis or adjusted cost basis column. The cost basis should reflect the value of the shares at the time they vested. The same amount was already included as income on your W-2. If your brokerage's cost basis shows $0 or is lower than the fair market value at vest, this is a huge red flag, and you may have paid taxes twice. This can mistakenly cause you to pay tax again on the full amount of your sale proceeds. Quick example, if your RSU is vested at $50 per share, that $50 per share is included in your taxable income already. Later, if you sell for $52, you should only owe tax on that $2 gain, not the full $52. If you notice that your brokerage listed the wrong cost basis, for example, $0, don't panic. This is common. You'll simply need to correct it on your tax return. Report the correct cost basis on Form 8949 of your tax return. Include an explanatory note such as corrected cost basis to reflect RSU values already included in taxable income at vesting. If you're uncertain or confused, consider reaching out to a CPA or tax advisor for assistance. A tax professional can help confirm and correct double taxation issues clearly and easily. In short, the 1099-B and Form W-2 can accidentally create a fire of double taxation, burning your whole house to the ground. Avoiding this disastrous tax trap isn't likely your life's mission, but it can help you get to where you want to go sooner, like spending time with loved ones, traveling, or spending time on your hobby. So let me show you how to shortcut that journey by walking through how many RSUs you need to retire early and live comfortably right here.